Good morning, everybody, and this is part 2 of the Chapter 2 video. This will finish out the remaining slides. This is a real important topic, business taxes, and the examples in the book are somewhat old as far as the tax tables go. But you should, as you're aware, the new tax rates have come out under President Trump. And but nevertheless, this basically just pinpoints the fact that corporations and individuals have to pay taxes, right? And you should be aware of the word capital gains tax, right? Capital gains is if you buy stock or anything and you buy it at price A, which is lower, then you sell it at price B. Whatever the gain is, you have to pay capital gains tax, okay? And you'll pay ordinary income tax on the dividends. All right, and you can see here, obviously, it's changed in the last couple of months, and they discussed that it changes frequently. So here's the corporate tax rate schedule. If you've never seen one before, as I said, these rates. Here's the marginal rates that are old, right? 38%. I think it's 21% now, or something like that. And you just take the base tax plus anything over the base and multiply it by 0.35. So these are the different rates. And again, remember, this is marginal tax rate here. Old, but the same. So here's an example of that. Here is a company that has before tax earnings of $250,000, and you use the table to find that category. 250,000 puts you over here, and your tax comes out after you do the calculation, which you should go through, of course, is $80,750. Now, bear in mind, the marginal rate in that case was 39%, right? And I just want to make a point. So here it is, 39% was the marginal rate. However, the average rate is the average tax rate was the money you paid in taxes divided by your income, and that comes out to 32.3%. So please make a note that there's two differences. There's a marginal tax rate, and there is an average tax rate. And the marginal tax rate you take right off the table. So, just an important point there. All right, so just go over that. That's important. All right, so as we talked about in class with dividends, there's a double taxation penalty. Companies pay taxes on their dividends, right, as the cash dividends, and then you get them, and then you pay taxes on these dividends. And as we talked about, interest on bonds, interest income on debt or bonds is interest income is fully taxed, and basically the interest on bonds you can write off. So I think they're a little unclear here. It says, unlike dividend income, all interest income received is fully taxed. And basically, any interest on a bond is the company's write off, and you pay taxes on the interest, but the company writes off the interest on bonds. All right, so here's a good example, and you should go over this example. Two companies using equity, stocks, and debt, and if you look at the table here, you'll notice this debt company, has $30,000 in interest expense, and basically, you can see them writing it off right here. They're subtracting it off, so their tax is only $68,000. Is everyone clear about that? Just make a note of that. Here, No debt is using stock, so there's nothing to write off, right? So they're earning their taxes is $80,000. All right, so you see they're paying more taxes, but that's why bonds are real important to a lot of companies. You can see what the difference is. So the use of debt, and this is an important line here, right? The use of debt financing, decreased taxes paid. So the tax deductibility of interest and other certain expenses reduces their actual after-tax cost to the profitable firm. It's the non-deductibility of dividends right here that result in double taxation. So this is a real important line, right? You pay and then the company pays. That's the double taxation. Save that. It's important, right? All right, so the other point is a capital gain, as we talked about already, but it's the amount by which you gain or lose on an asset. So if I buy stock at $10 and sell it at $30, I have a $20 capital gain, right? And it's a good example here of that. All right, so capital gains are added to ordinary income. Now, this may not be true, completely true. Things may have changed. These rates change all the time, so, and it may have changed recently. So, you know, you should take that with a grain of salt. For corporations, capital gains are added to ordinary income and taxed like ordinary income at the firm's marginal tax rate. So you always got to check that to make sure that things haven't changed in the with the IRS. All right, so really that's about it for this chapter. The important points are these tax tables. All right, so please understand how these tax tables work and what you can write off. Right, this was important. And of course this difference here, right? This is a marginal tax rate and an average tax rate. Understand how this calculation is done here for the marginal tax rate. Alrighty. Talk to everybody soon.